Before performing a deeper financial analysis of Home Depot's financial statements, it is important to understand what makes companies successful. So in this video, we cover the key areas of business performance. We begin by first identifying the key elements of running a successful business by briefly reviewing what we had to do to start our own business. Remember gone fishing back in video 7 of this series, entitled Key Areas of Running a Business Gone Fishing? In that story, we had to arrange our financing by attracting $200,000 of equity capital and then $300,000 of debt capital. In doing so, we established our capital structure, $500,000, 40% equity capital, and 60% debt capital. Another term used to describe the extent to which we rely on debt in our capital structure is leverage. Here the capital structure is 60% levered. That is, 60% of the company's financing is comprised of debt. It is called leverage because debt can act like a lever. If the company can use the $300,000 of debt capital to create annual profits, say $30,000, that exceed the annual interest cost of the debt, which in this case is 8% times $300,000 or $24,000, the company will increase bottom line net income, which belongs to the shareholders, by $6,000 without using any of the shareholders' investment. This can significantly boost, like a lever does, the shareholders' return or return on equity, ROE, net income divided by the shareholders' investment. Let's work an example to demonstrate the power of leverage. Suppose a company needs $1 million for a project that is expected to produce an annual return of 10%, or $100,000 per year. In scenario 1, assume that the project is financed by issuing stock for $800,000 and borrowing from a bank $200,000 at a 5% annual interest rate. That is, the project is financed via 20% leverage or debt and 80% equity. Assume further that during the year the project creates the expected $100,000 in profit, with the $10,000 interest cost, 5% times $200,000, leading to a net bottom line profit of $90,000, and a return on the $800,000 equity investment of 11.25%, $90,000 of profit divided by the $800,000 equity investment. In scenario 2, let's increase the level of leverage from 20% to 80% and see what happens to the return on equity percentage. Assume here that the company finances the $1 million project with $800,000 of debt and $200,000 of equity, which increases the leverage from 20% to 80%. Again, as expected, the project creates a $100,000 profit, but this time the additional interest cost of $40,000, 800,000 times 5%, leads to a reduced net profit compared to scenario 1, from $90,000 down to $60,000. However, the return on equity calculation jumps from a little over 11% to 30% because the equity investment is much, much lower. In essence, the company used the bank's money to provide a higher return to the shareholders. Yes, profits were reduced, but the ROE almost tripled.